The Psychology of Investing. Chapter 14. Learning from Investment Mistakes. We review investment decisions because the market is noisy, and noise can easily teach the wrong lesson. A careful, well-reasoned decision can still lose money if events break against you. At the same time, a careless decision can make money simply because luck happened to cooperate. If you only watch results, you may punish discipline and reward randomness. A review process helps you ask a better question. Was the decision itself sound, given what I knew at the time? That is how experience turns into actual improvement, instead of confusion. An after-action review is just a structured way to look back without getting trapped in emotion. You revisit what you expected, compare it with what actually happened, and explain the gap as honestly as you can. That gap may come from a flawed assumption, missing information, a timing issue, or simple market uncertainty. The final step is the most important one: deciding what, if anything, should change next time. This keeps the review practical rather than emotional. Instead of replaying the trade in your head, you extract one useful lesson. The central principle is to separate process from outcome. A strong process does not guarantee a gain, because markets are uncertain and many things remain outside your control. Likewise, a weak process does not always lead to an immediate loss, which is why luck can be so dangerous. If you reward lucky behavior, you quietly teach yourself bad habits. If you punish disciplined behavior after one bad result, you weaken the very system that protects you over time. Good investing depends on respecting the process, even when the short-term outcome is disappointing. Consider two simple examples. If you buy a stock only because someone gave you a tip and it rises, the profit feels validating, but it does not prove the method is sound. You may have made money for the wrong reason. On the other hand, imagine you sell when your target price is reached and the stock keeps climbing after you exit. That can feel frustrating, but it does not automatically mean the sale was a mistake. In both cases, the visible result is misleading. What matters is whether the decision followed a thoughtful, repeatable process. A good review can be built around four simple questions. First, what did I expect to happen, in concrete terms? Second, what actually happened? Third, why was there a difference between the two? And fourth, what will I do differently next time? These questions are powerful because they are short enough to use consistently, yet deep enough to reveal weak assumptions, emotional decisions, or missing research. When you answer them honestly, even a painful trade becomes useful. A review works best when it is brief, calm, and recorded in one place. In many cases, 5 to 10 minutes is enough, especially if you wait a day or two for emotions to settle. If you review too quickly, anger, embarrassment, or relief can distort the lesson. Keeping all reviews in a notebook, spreadsheet, or simple document makes later pattern recognition much easier. At minimum, record the date, the investment, the action you took, and the basic reason for it. The goal is not to create a complicated archive, but a reliable habit. Specificity matters because vague reviews are hard to learn from. Writing that a stock looked good or felt strong tells you very little when you come back later. It is far more useful to state your expectation clearly, including a price range, a time frame, and the reason for the trade. You should also note the assumptions behind the decision, such as stable interest rates, improving margins, or stronger earnings. Then record the outcome as a simple fact, without drama or self-judgment. Clear expectations and factual results make it possible to compare belief with reality. Once you have described the difference between expectation and outcome, The goal is to find the cause and then choose one improvement. Some causes were knowable, such as weak research, unrealistic assumptions, or a rushed decision. Other causes were outside your control, such as a surprise policy change or an unexpected earnings shock. The skill is learning to separate controllable errors from uncontrollable surprises. If the problem was in your process, identify it directly. Then choose one concrete next step, because one specific improvement is far more useful than a long list of vague intentions. Take Alex as an example. He bought a renewable energy stock at $50 because he believed new clean energy subsidies would lift the sector and push the stock to $60 within 3 months. Instead, the company reported weak earnings and the stock dropped to $45. His original sector idea may not have been unreasonable, but his review shows that he leaned too heavily on the industry theme and not enough on company-specific fundamentals. In other words, he let a broad story outweigh detailed analysis. A better process next time would include reviewing recent earnings, comparing competitors, and testing whether the business itself is strong enough to benefit from the theme. The real value of this review process appears when it becomes a habit. One review can teach you something, but many reviews begin to reveal your recurring tendencies. That is why you should review winners as well as losers, because gains can hide weak reasoning, just as losses can hide good discipline. It also helps to reread older reviews after some time has passed. Distance makes patterns easier to see. Brief, honest, repeated reviews gradually turn scattered experiences into a clearer picture of how you actually invest. One of the hardest parts of investing is that outcomes and decision quality often diverge. A trade can be well researched, reasonably sized, and still lose money. Another trade can be careless, impulsive, and still produce a gain. If you judge purely by the result, you absorb the wrong lesson from both. That is why good investors keep asking how the decision was made, not just how it turned out. The market adds noise between process and outcome. Learning begins when you stop treating that noise as proof of skill or proof of failure. The key distinction here is between bad luck and a bad decision. Bad luck means the outcome was poor because of uncertainty or an event you could not reasonably control or foresee. A bad decision means the choice was weak based on the information that was available at the time. Markets move for many reasons, and not all of them are predictable. So when you review a trade, ask what was known then, not what seems obvious now. That keeps your judgment fair. It also prevents you from blaming yourself for every loss or excusing every mistake as random chance. A much better review standard is this. Given what I knew at the time, was this a reasonable decision? That question shifts attention away from the emotional sting of the result and back toward the quality of your reasoning. It reduces overconfidence after gains because a profit does not automatically mean your thinking was strong. It also reduces self-blame after losses because a loss does not automatically mean you were careless. Over time, this makes your learning steadier and more accurate. You become less reactive and more disciplined in how you improve. A simple trade review starts before the trade itself. Record your thesis, the facts supporting it, the risks you see, and what would change your mind. Then give the idea time to play out over the horizon you originally intended, instead of judging it by daily fluctuations. After that, compare the eventual outcome with your original reasoning. If the trade failed, ask whether the result came from a risk you ignored or from a surprise event you could not have reasonably anticipated. That separation is essential. Without it, every bad result feels like a mistake, and every good result feels like skill. After reviewing process and outcome, it helps to classify the trade clearly. Sometimes you have a good decision followed by bad luck, and the lesson is to keep the process. Sometimes you have a bad decision followed by bad luck, and the lesson is to fix the process. Sometimes you have a bad decision followed by good luck, which is especially dangerous because luck can disguise poor judgment. And of course, sometimes you have both a good decision and good luck. This simple classification makes the lesson visible. It stops you from using one emotional result to define the whole trade. Maria's example shows why this distinction matters. She bought shares after reviewing the trial data, identifying FDA approval as the catalyst, and recognizing rejection as the main risk. When the FDA rejected the drug because of an unexpected technical issue that had not been clearly flagged, the stock fell sharply. She still lost money, but the process was not reckless. She had documented evidence, named the catalyst, and considered the downside in advance. In this case, the cleanest lesson is not that she traded badly, it is that she made a reasonable decision and encountered bad luck. Now, imagine the same stock, the same buy price, and the same loss, but with a different process. If Maria had bought only because a friend sounded confident, and she had done no independent review, the lesson would change completely. The outcome would look identical on the surface, but the reasoning underneath would be much weaker. That is why outcomes alone are so deceptive. Unverified tips, borrowed conviction, and missing research all point to a bad decision process. The loss would no longer be mainly about luck. It would be evidence that the choice itself was poor. A short checklist can help you separate luck from judgment after any trade. Ask yourself what your thesis was at the time and what evidence supported it. Ask which risks you had identified in advance, and whether you are judging the trade with then-known facts or with hindsight. Also ask whether you followed your process or reacted emotionally. These questions are simple, but they force clarity. If your answers are clear, the process was probably stronger. If your answers are vague, that usually means more structure is needed. There are several review mistakes that can distort what you learn. The first is measuring skill by outcome alone, which causes you to reward luck and punish discipline. Another is hindsight bias, where events feel obvious only after they happen. Investors also make mistakes when they abandon a good process after a short run of random losses. Vague reasoning and ignored emotions can weaken the review as well. And one of the most common errors is reviewing only losing trades, even though winning trades can also reveal bad habits hiding behind good luck. Investment results will always contain noise, so the most valuable habit is to evaluate the process behind each choice. A loss is not always a mistake, and a gain is not always evidence of skill. What improves judgment is the repeated practice of asking whether the logic was sound, whether risks were considered, whether emotions were controlled, and what should change next time. This keeps your focus on the part of investing you can actually improve. Over many decisions, better reviews lead to steadier judgment. That steadier judgment matters far more than any single outcome. A loss naturally brings disappointment, and that reaction is normal. Trouble begins when disappointment turns into repetitive mental replay instead of useful reflection. Rumination sounds like analysis on the surface, but it usually circles around regret, blame, and imagined alternatives. You keep revisiting what you should have done without reaching a clear lesson. That is why attention to a mistake is not the same as learning from it. Real learning moves toward resolution. Rumination keeps you stuck in the past. The difference between reflection and rumination is whether your thinking produces a clearer process for next time. Reflection is structured, brief, and aimed at understanding what happened and what to change. Rumination is repetitive, emotional, and often driven by hindsight. Reflection examines the decision. Rumination attacks the self. One asks, what was in my control and what rule should improve? The other says, I should have known, or I always do this. That difference matters because only one of those paths leads to better investing. Self-punishment feels serious, but it does not improve judgment. In most cases, it drains mental energy and keeps fear, shame, and embarrassment active long after the trade is over. That emotional pressure can distort what happens next. You may overreact by selling too quickly, avoid investing altogether, or make a reckless trade to win the money back. None of those responses comes from clear thinking. Dwelling on the mistake weakens confidence and makes future decisions worse, not better. A useful principle to remember is that you cannot change the last trade, but you can stop it from harming the next one. That means catching rumination early before it starts shaping your confidence and behavior. Instead of replaying the event, replace it with a brief review. Protecting your judgment is just as important as extracting a lesson. Then choose one constructive next step and let the rest go. The goal is not to erase the disappointment. It is to prevent yesterday's emotion from becoming tomorrow's mistake. One simple way to interrupt rumination is to use a short, repeatable process. First, notice the loop and label it directly. I am ruminating. That small act creates distance between you and the thought pattern. Second, set a strict 5-minute review limit so the mind does not drift back into endless replay. Third, ask one action-focused question, such as, what can I do differently next time? Finally, write one concrete lesson. The point is to convert emotional repetition into a specific improvement. After you identify a lesson, it helps to reset before making any new investment decisions. Do one neutral task, take a short walk, or create some small break in state. This lowers emotional intensity and reduces the chance of an impulsive response. It also helps to accept that some losses involve uncertainty rather than personal failure. If there is a lesson, add it to your process. If there is not, accept the outcome and return to your next planned action rather than searching for emotional relief through trading. Maya's example is familiar to many investors. She is down $400, keeps reopening the app, and tells herself she is analyzing the trade, but really she is replaying regret. The turning point comes when she labels the pattern honestly. I am ruminating. She then gives herself 5 minutes to write out the frustration instead of carrying it around in her head. After that, she asks what rule would actually help next time. Her answer is practical. A 10% stop-loss rule for future trades. That is the moment regret becomes process. Several habits keep investors trapped in pain, while making it look like they are learning. One is mistaking long thinking for useful analysis, as if more replay automatically means more insight. Another is believing harsh self-talk creates discipline, when it usually just increases shame. Some people respond by trying to win the loss back quickly, which often leads to revenge trading. Others swing to the opposite extreme and avoid investing completely after one mistake. These are all emotional responses, not learning responses. The better path is quieter. Review the process, accept uncertainty, and make the next decision calmly. When a recent loss keeps bothering you, reduce it to a short self-check. Start by stating the facts in one sentence, without exaggeration or blame. Then write the repeating self-critical thought exactly as it appears in your mind.
Replace that thought with one productive question, such as, what rule would reduce this kind of mistake next time?
Answer with one actionable rule, and then stop.
Facts, a rule, and a break are usually far more helpful than another hour of regret.
A mistake log is valuable because emotional memory is selective. We tend to remember the pain of a bad decision, but the exact details of why we acted often fade quickly. By recording what happened while it is still fresh, you preserve the part that matters most, the process behind the choice. Over time, that record makes repeated errors much easier to detect. Instead of carrying regret around as a feeling, you turn it into usable information. That shift is what makes future decisions better.
A mistake log should focus on decisions that went wrong because the process was weak,
not simply because the outcome was negative. That includes breaking your investing rules, acting without a clear plan, ignoring relevant information, or letting emotion override judgment. A loss by itself does not automatically belong in the log if the process was sound, and a gain may belong in the log if the decision was careless and only happened to work. This is an important discipline. You are logging process failures, not just unpleasant results. The real purpose of the log is to reveal patterns, not to collect isolated stories. One bad outcome may be bad luck, but repeated versions of the same behavior usually point to a habit. Maybe you keep buying after sharp price increases. Maybe you panic and sell after a short decline. Maybe you follow tips without doing your own research, or you hold losers too long because exiting feels painful. A single event can mislead you. Repetition is what exposes the pattern that actually needs attention. The best system is a simple one you will actually maintain. It can be a notebook, a spreadsheet, or a notes app. The tool matters far less than consistency. Try to write entries within 24 hours while the memory is still clear. Keep each entry short and direct so the habit remains easy. Then review the log regularly, instead of letting it become a forgotten document. A fancy system used inconsistently is much less helpful than a basic system used every time. A consistent entry format makes pattern detection much easier. If every note follows the same structure, your eye starts to notice repeated words, behaviors, and emotional states. A simple format might include the date, the investment name or ticker, the action you took, what went wrong, and the consequence along with your mental state. That is enough to make entries comparable across time. You do not need a complicated journal. A few clear lines are often more useful than a page of scattered detail. A mistake log becomes useful when you review it on a schedule. Weekly or monthly review times help you move from isolated memories to visible patterns. As you reread entries, look for repeated triggers like market drops, headlines, or fear of missing out. Notice repeated rule violations and recurring emotional reactions. Then ask which mistakes were one-off errors and which ones reflect a deeper habit. An unread log is just a diary. A reviewed log becomes insight. When patterns begin to appear, resist the urge to fix everything at once. It is usually better to choose the most frequent or most costly problem and create one specific response rule. That could mean waiting 24 hours after exciting news before buying, or rereading your thesis before selling out of fear. The point is to connect observation to action. Gradual process improvement works better than a flood of vague intentions. One pattern, one rule, consistently applied, can change behavior surprisingly fast. Maya's log helped her see that her losses were not random. Across 3 entries, she noticed the same themes appearing again and again. She bought based on hype, outside opinions, or dramatic headlines without enough research. She also felt fear of missing out on the way in and fear of short-term losses on the way out. In other words, she was buying from hype and selling from fear. Once the pattern was visible, the problem became much easier to address. The log turned a vague feeling of frustration into a concrete behavioral diagnosis. The next step for Maya was to turn that insight into a rule. Before buying, she now writes one long-term reason to own the investment. That sounds simple, but it changes the decision standard. A price jump alone is not enough. A headline alone is not enough. Someone else's opinion is not enough. The rule forces her to anchor the decision in future business value, rather than short-term excitement. That is how a pattern becomes a process improvement.
A mistake log works best where it stays focused, manageable, and honest.
One common mistake is logging only losses, even though profitable trades can also reveal bad process. Another is making entries so detailed that the system becomes burdensome and eventually gets abandoned. Some investors blame only the market or the news and ignore the part they actually controlled.
Others skip small mistakes, even though repeated small errors often point to major habits. And of course, a log that is never reviewed cannot teach much. The value comes from honest recording and regular reflection.
The purpose of a mistake log is not self-punishment. It is to help you distinguish bad luck from bad process, spot recurring patterns, and make steady improvements over time. You record the decision honestly, review it for repeated behaviors, choose one practical improvement, and then build that new habit gradually. This turns reflection into a better system rather than a harsher self-image.
In that sense, the log is a learning tool, not a record of failure.
Volatility is not a flaw in investing. It is part of the experience. Prices naturally move up and down as new information arrives, expectations change, and investor sentiment shifts. Stocks are especially volatile because they reflect uncertain future cash flows and changing confidence about growth. In the short term, many price moves are simply noise rather than meaningful signals. That is why a rough market does not automatically mean something is broken. Learning to see volatility as normal is a major psychological advantage. Even when investors understand volatility in theory, real price movement can still feel personal. Falling prices trigger fear because they create a sense of danger and loss. Rising prices can create excitement and the urge to join in before it is too late. In both cases, emotion creates urgency to act. That urgency often leads to poor timing, such as selling after a drop or buying after a run-up. The market may simply be doing what markets do,
but the mind experiences it as a call to intervene.
A Stoic mindset helps by separating what is outside your control from what is within it. You cannot control daily returns, short-term drops, headlines, or sudden changes in sentiment. Trying to control those things usually leads to frustration and reactive behavior. What you can control is your risk level, your savings rate, the quality of your research, and your behavior under stress.
That is where your effort belongs. Stoic investing does not mean feeling nothing. It means directing energy toward the part of the game you can actually manage.
Acceptance is not the same as indifference. Stoic acceptance means recognizing many market moves as background conditions rather than instructions to react. The same volatility can produce two very different responses. One investor treats every move like a command and becomes trapped in constant checking, buying, and selling. Another keeps the movement in context and follows a plan, reviewing only when something meaningful has changed. This also helps keep your identity separate from performance. A down month does not make you foolish, and an up month does not make you brilliant. Steadier behavior becomes much easier when you prepare before emotions take over. Start by expecting uncertainty in advance, instead of acting surprised when markets move sharply. Then, separate facts from feelings by asking whether the thesis, earnings outlook, valuation, or long-term reason has actually changed. If not, return to the long-term plan rather than the short-term emotion. It can also help to use a cooling-off rule, such as waiting a set number of days before making a trade during a volatile period. Rules create space between feeling and action. That space is where discipline lives. Tolerance for volatility can be built gradually. One helpful reframing is to see volatility as part of the price you pay for higher expected returns. Another is to begin with manageable amounts so you can learn without overwhelming stress. Smaller stakes make it easier to observe your own reactions and strengthen discipline. Experience also helps, especially when you stop checking the portfolio too often. Frequent checking magnifies emotional swings. Less frequent checking often makes the same investment easier to hold calmly. Alex's example shows what this looks like in practice. He invests $10,000 with a 10-year time horizon, and 2 weeks later, the fund falls 8%. Instead of selling to relieve the discomfort, he reviews his plan. His time horizon is unchanged, the portfolio is still diversified, and his long-term goal is still intact. Because the thesis has not changed, he stays with the plan. Later, the fund recovers and rises to about $11,200. The lesson is not that every decline will reverse quickly, but that disciplined behavior protects you from turning temporary volatility into permanent damage. Most volatility mistakes come from misunderstanding what normal market movement looks like. Investors often expect stocks to rise smoothly, even though real returns usually come with jagged ups and downs. Checking prices too often magnifies every fluctuation and keeps emotions activated. Another mistake is treating gains or losses as proof of skill. When many short-term moves are simply noise, some people sell just to relieve discomfort, even if nothing important has changed. Others abandon a sound long-term plan because the emotional pressure of volatility becomes too strong. A simple reflection exercise can help you practice this skill. Start with a recent price move and write down the exact market fact, such as a 6% drop in 2 days. Then name your first emotional reaction, whether that was anxiety, excitement, frustration, or urgency. Note what you did or wanted to do in response. After that, ask whether the move represented a real change in the investment case or just normal volatility. Finally, create one rule or reminder for next time, such as waiting 24 hours before acting and rereading your long-term goal. This is how you train yourself to separate market facts from emotional impulses.